Johnson & Johnson just reported $24.75 billion in revenue, beating expectations of 23.6, and they reported $2.68 EPS versus an estimated $2.50. So they did a great job. Let's see how they're doing right now in our software. They're actually down. Is that interesting, Mo?
Yeah.
Down 2%.
Wow, 2% is a big move for them.
That's a very big move, especially on we're currently right now in up day. Now, Johnson & Johnson just also 61st year in a row of increasing their dividend. That's an incredible, incredible feat. Their current dividend is 2.7%. Now let's look at the dividends, because if you're new to our channel, the one thing I want you to remember is that dividends aren't just something that's guaranteed. You got to compare the dividends to what I believe is free cash flow. A lot of people will suggest that you compare it to net earnings. However, free cash flow is the best route. Dividends paid, $11.7 billion. Last year's free cash flow was 17. The last 5 years, average free cash flow was 19. So they can adequately afford this. We like to keep it under 50%. However, Johnson & Johnson is probably not a massively growing business.
Correct.
Right? So they're let's look at their revenue growth of the last 5 and 10 years. Yeah, it's 3-4%. So when you have a business that's not growing very fast, there's probably not a lot of room for growth. So how do you return money to investors? Well, you buy back stock or you pay dividends, right? And this dividend is pretty solid. 2.7%, well above the market. Right now, S&P is around 1.2, 1.3, 1.4, somewhere in that ballpark, right? Mm-hmm. But it's there. Okay. Market cap, $433 billion with an enterprise value of $520. The difference there essentially is the debt. All right. Not a terrible amount of debt. Mo, what do you think?
No, I mean, especially, I think that's probably pretty standard in the industry, sitting at those levels.
Yeah, and we're going to talk about this in a little bit. They just took on some debt for an acquisition that really jumped up some things.
And in their case, if they want to grow, probably going to be doing it by acquisitions.
Yeah, you're probably right. So look at this profit margin, very consistent, around 19%, with a gross margin of 67%.
That's pretty damn big.
And a very consistent ROIC. 5 years of 12.8, 1 year of 12.8. And guys, if you look at our stock analyzer tool, we just added this today. We're showing the 1, 5, and 10-year return on invested capital, just so you can see the trend on where it's going. So it's a very consistent 13% or so return on invested capital. We'll get back to the stock analyzer tool shortly, of course. Let's go check out the 8 pillars. All right. Cash flow is down over the last 5 years. Mo, do you want to look into the cash flow statement? Oh, that's what you're doing right now.
Yeah, that's what I was doing. So it peaked in 2020, and it's been falling back down till.
And you see the change in the working capital the last 2 years have been a big difference.
Right.
Above. So
right up here. Yep.
Yeah, that's a big difference. Okay. So I'm not terribly worried about that. But of course, we have two X's. Where? Valuation.
Yeah.
Okay.
These guys make a lot of acquisitions also.
How many?
$17.6 billion in 22, and then you go to 2020, $7.3 billion, 2019, $5.8 billion, 2017, $35 billion.
Okay, so what does this raise a red flag for me? How much of this revenue growth was acquisition based? Because I don't like my personal. So CEOs like to look very busy by making acquisitions. It makes investors feel like they're doing something to really grow the business. But I want to look at the company and say, how do they grow the business without the acquisitions? What was their natural organic growth? And these are the questions you need to ask when you're looking at a company. And it's much easier in a company like, I was just looking at Ulta Beauty today. And I can go to their 10K and look at their comparable store sales growth over the last however many years I want to look, right?
Yeah.
I can't really.
It's harder to do here.
It's harder to do here. Correct. Yeah. Right? So, and Johnson & Johnson's got a wide variety of products.
Lots of them.
They've got drugs, they've got everyday home items, they've got a lot of different things.
Right.
So I imagine the everyday home items that you're used to buying are going to grow about with inflation, right? I mean, what else are they going to grow? Band-Aids, things like that, like, shampoos, they're not growing like crazy. It's the drugs that they try to get, the pharmaceutical area, where they're going to try to really get some major growth and some major profit, because those are very, very high margin businesses. I'll be honest with you, Mo, I was surprised by this gross margin. I would not have guessed 67% on Johnson & Johnson.
Yeah. There was a couple things in their press release that they released today. Consumer health worldwide adjusted operational sales increased 11.3%, mostly driven by Tylenol, Motrin, upper respiratory, Imodium for digestive, et cetera. Pharmaceutical grew 7.2%.
Wow.
Driven by some of their cancer drugs. Let's see here.
That's great.
MedTech operation grew 6.4%. So there is growth in different areas.
They're growing on the non-consumer health side, it seems more.
Yep.
Which, by the way, is probably higher margin. Because once you make a drug, it's not hard to replicate that drug over and over again, right?
Right.
Now, let's take a look. And remember, guys, these are the pillars I use because we created them. But again, you can create your own pillars. You can do it yourself as part of our software. And how you do that is just right up here in Tools. You go to Pillar Screener and start editing your pillars, or right here, just hit the pencil button and edit it. So let's look at the analyst estimates. They're expected to make $10.62 a share this year. And their current stock price is what, Mo?
Current is 161.62.
So that would put it about a 16 PE for the year. Okay, not bad.
Not bad.
And look at this growth, though. Pretty poopy.
Yeah, it's pretty bad.
So, and by the way, you think they're not going to make any acquisitions? This is kind of...
They're going to make acquisitions.
So I look at this as a slow grower with a decent return on invested capital. It's not. I'm not looking at 13% going, F yeah. I'm looking at 13% saying, okay, not bad. They're getting a return on the money that's invested in the business. It's above the markets. The market should do about 10%. But you have to pay a reasonable price for the company. So what's that reasonable price? I don't know. Revenue growth. Wow, isn't that interesting? Revenue looks like it's going to grow faster
than earnings per share.
Very interesting.
Yeah.
Are they buying back shares, Mo? How many?
Yes, they are very, very, very slowly.
Okay, that's good.
Yeah.
All right, so why do I say that's good, guys?
I mean, from 2019 through 2021, they didn't buy back any shares.
Probably because of COVID.
Exactly. And then they just began a very slow buybacks in 22.
So the reason I'm happy about that is if they get cheap enough, they need to spend every dollar they make buying back shares. That's how you're going to increase a lot of value for investors. A very unpopular comment here. Stop the dividend if they get cheap enough. You know, a lot of people love getting that dividend check, and I get it. It's wonderful to get that money every month. I see people on Twitter all the time bragging about, I got a $37 dividend today. I said, great. It's not tax efficient, and if the stock is cheap enough, you want the company buying back shares, not paying out dividends.
If this company cuts their dividend, like slashes it in half or something, this stock is going to plummet.
Oh, yeah, 100%.
Because this is one of those where all the old people are in it. I want the dividend here. This is what I want.
100%.
Them and AT&T. You know?
100%. So, Mo, what are some bull and bear cases for Johnson & Johnson?
Yeah, we pulled some here. I'm just going to put them up on screen here. Let's go with, there we go. So, again, they completed an acquisition. And this was big news when they were talking about their heart failure and recovery. So, it's a large unmet need
for the company.
And that is a good thing. It's a place of growth for them.
Now, we have not looked at a biomed to evaluate whether they paid too much or too little.
Right.
My guess is they probably paid too much because companies tend to pay too much.
Exactly.
All right, what's another one?
All right, in 2022, they advanced 5 drugs in their pipeline to U.S. approval.
Wow.
That's good. That's really good. So trying to settle some lawsuits now.
Wait, look at that one. By not letting any one drug take up more than 5% of R&D spend.
Yeah. I hope they stick to that.
That's a very...
Hope they stick to it, though.
Yeah, I know, but but that's amazing. That's a very diverse. That lets them put a lot of darts out there to see which ones stick.
Yeah, now, everybody knows about the talcum powder thing with causing cancer. So they're trying to settle for $60,000 of claims.
60,000 claims
and
$9 billion in settlements.
Yeah.
All right, maybe that would be their excuse to cut the dividend.
That's also in the bear because that would be a big output of cash.
Yeah.
But at the same point, I think they'll figure something out.
Listen, market doesn't like uncertainty.
Yeah.
So if this is managed and it's put away, the market likes that. They want to get rid of all the uncertainty out there, as much uncertainty as possible, right?
Yeah.
I'm not seeing it from a long-term perspective. From a short-term perspective, that could be a bullish case. From a long-term perspective, I don't care.
Exactly.
They're going to have these.
Exactly. I mean, if you look in the pharmaceutical industry, this happens all the time. There's always major lawsuits pending. Now, you really like this one. Increasing net debt position from $2.1 billion to $16.1 billion year over year due to the acquisition of ABO Med, citing access to extend.
So what do you mean I like this one?
You said you like this one.
No, I meant in sense of I think it's a good thing, a good bearish case to sit there and say, listen, they took on this debt. I haven't looked at the deal. Yeah. If you're interested in J&J, I do recommend And if you're in a community, somebody in here, I'm sure, has expertise to sit there and look at that deal and talk to you about what they think about it.
Yeah. And another thing I want to point out, when you guys are looking at companies like this, I mean, they are very big in this pharmaceutical world. I think you need to go and find some of these drugs and see, when do they come off patent? Because that's an important thing.
Yeah.
When they start making biosimilars and generics, you have to wonder, okay, what's going to happen with these drugs? What's going to happen to that revenue?
Yeah, in the pharmaceutical world, guys, and we've done videos in the past about Biogen, Pfizer, Merck, everything. The pipeline's everything, but not just the pipeline. The pipeline that can lead to market-moving drugs. You know, a company can have a phase 3 and an approved trial of some drugs and go, okay, great, but the market value is $50 million a year. For Johnson & Johnson, that's not going to do anything. Now, do I think they're really doing that? No, but sometimes they go down a path of a drug and things change. That's why they have a lot of drugs out there.
Yep.
And I think in their 10K, they'll have in there all their phase 1, phase 2, phase 3, where everything is. And it's a great thing to look at. I think it's something you have to understand as in a drug company. It tends to be why I avoid drug companies, but also why I like Johnson & Johnson. It's a more diverse, they have the consumer healthcare side. It's more diverse. So the question we have to ask ourselves now is, what do we pay for the company? So guys, before we get there, our price just went up today on the software, but you can get it now. It's just $1.30 per day. Lock it in now. Whatever price you get today, you're locked in that level for the rest of the time. Doesn't mean you're stuck at $39, but when the software goes to $99, you'll be at that $39 level. So instead of 30, it might go to 42 when 99 becomes 102. Sign up now, $1.30 per day. This thing is going to change the way you look at things. It's all the tools, all the community. As we add tools, real estate calculators coming soon. This is a no-brainer, guys. We're working on the software constantly. We have 5 developers on the software, constantly making better. Everythingmoney.com. Sign up now, $1.30 per day. So I'm going to look at Johnson & Johnson for 20 years. Mo's going to do an analysis for 10 years. The reason being, Johnson & Johnson ain't going away.
No.
And the question we have to ask ourselves is one of 3. 1, is the company going away? Probably not. 2, do I think the company will be making more or less revenue and profit in the next 10 or 20 years than they are today?
I would say more.
Probably more. Just inflation driven, it'll probably be more. 3, can I pay a reasonable price today for the company that gets me an adequate return on my money based on those assumptions? And that's what we're doing here with the stock analyzer tool. So just stick with us. We're going to put a quick break in the video. We'll be right back in 2 seconds. All right, we were just told by Nick that he hates Johnson & Johnson for no reason other than sports reasons. So whatever that's worth to you, please don't worry about it. So I did a 20-year analysis. Mo did 10. And again, our ROICs are right here. Mo, what'd you put in for revenue growth?
So I did 1, 2, and 3.
All right, I did 2, 4, and 6. Mo, I do believe that inflation will drive up. Because look at our inflation in the last 10 years. It's been pretty calm except for the last year.
Yeah.
You're probably looking at me like,
I don't see 6% revenue growth.
I don't either. That's why I have a much higher desired return.
Okay.
But if they get a few drugs that hit big, remember, the goal here is all the things they're working on. Is that a hard number to hit? Absolutely. That's going to take their revenue like 3 times more, not 3 times. Yeah, maybe 3 times more than it is today. That's a big feat.
But
it's also an idea, even if this is ridiculous, when we see the value that comes up for this, it'll tell you, it'll put in perspective today's price. That's the other reason to put it in there. Okay. What'd you do for profit margin?
18, 20, and 22.
I did 18, 19, and 20.
Okay.
Free cash flow.
I did the same thing, 18, 20, and 22.
I actually did 18, 19 and a half, and 21 because I saw such a big difference between free cash flow and profit margin here.
Right.
All right.
Yep.
Now, this is a big thing, guys. A lot of people who get the software, you need to use this over and over. Get the help in the community to sit there and make your assumptions. It just takes a few tries before you get the hang of it. But you have to think like, okay, I have to look at the history here. All right, PE. Now, this is one area where I just ignore history, basically, but I want to see relative to where it is.
Yeah, I did 16, 17, and 18 for PE and price to free cash flow.
Yeah, I don't blame you. I did 15, 16 and a half, and 18. Okay, so maybe I counted for this higher revenue growth number than you'd like by putting in this 15 PE.
Okay, fair.
And then desired return.
I did 10, 11, and 12.
I did 9, 11 and a half, and 14.
And I went lower with my return because with 1, 2, and 3, I don't feel like I need as big a margin of safety as you do.
You might be right.
So
you might be right. And I'm on the high end, the margin of safety. The low end, I put it.
Right.
The stock's currently at 160. I hit the analyze button. Here are my values. 95 on the low side, high price of 102, mid price of 100. And look, it's on my watch list at 100. I want to make note, guys, before you hear Mo's numbers. 160 would drop it quite a bit. Remember, this is a low growth company. There's not a lot of growth in it, so you have to pay a cheaper price to be able to get your value. Mo, what values did you get?
I had 85 on the low, 112 on the high, 98 in the middle. It's on my watch list at 100, and it was at 111 in March of 2020. So it's been there recently.
All right, so we have basically the same middle number. Guys, thanks very much. Again, everythingmoney.com, $1.30 per day. You get all the software plus all of our changes in the